Well, at least I'm sharing my screen. I don't think they can hear me. There's nothing I can do about that. So remember also when we said that probably the most important concept here is that we can explain what revenues and expenses are without never saying that we are talking about cash. Okay, remember? And this is very important because if you look at the formal definition, the official definition of what revenues and expenses are. Okay. So revenues are increases in the economic benefits during the accounting period. This is the official definition taken from the International Accounting Standards. Okay, so increases in economic benefits in the form of inflows or enhancements of assets, or decreases of liabilities other than contributions from the equity participants. What does it mean? An inflow, it means you have more assets. Okay, for instance, the easiest way of thinking about this, more cash, right? So if you have more cash, and this is not a contribution, this might be a revenue, must be a revenue, right, according to this definition. However, it says assets. It doesn't say other, it doesn't say cash, okay, it just says assets. So any asset can generate a revenue. Any inflow of assets can generate a revenue. Any enhancement of assets can generate a revenue. Okay, not just the increases in cash. Enhancement might mean that you have an increase in the value. So you're holding a building, and this building increases in value, revenue, right? Because you have an asset that increases in value, which is enhanced, okay, so to say. Non-cash items, you have an inventory of products, and it increases because you manufacture more revenue. Right, if you look at this definition. So any asset can generate a revenue. Any increase in assets can generate a revenue. So as we said on Friday, some of the revenues will be cash revenues, of course, but some will not. So not all cash revenues, not all revenues are cash revenues. There are some cash revenues, okay, of course, but the idea is that not all revenues are increases in cash. Okay, so as we'll see in a moment. And the same is true for expenses. That's the formal definition. Outflows of assets. Okay, so I pay money to someone. Okay, that's an outflow of an asset, and I'm not paying a dividend, then it is an expense. Think about a salary. Okay, so I'm paying a salary to the employees, I'm decreasing my cash, and I also report an expense. So that's certainly the easiest form of expense we can think of, a cash expense, right? Once again, any asset can generate an expense, and for instance, one of the most important expenses for us would be the cost of goods sold, which means when you sell an item, this item is going from your firm to the customer, therefore it's an outflow of an asset, right? So if you sell smartphones, okay, so the smartphone you're selling is going to be delivered to the customer. This is an expense. Why? Because there's an outflow of a smartphone, which is an asset, an inventory of merchandise. So you are showing an expense, which is not money, which is not a payment yet. It's an expense we need to report in our accounting system, and we call this the cost of goods sold. Okay, so we have plenty of those examples of expenses which are not payments. Also, deflations. Deflation means the decrease in the value okay, in the usefulness of something. So using the asset decreases its value. So for instance, think about this, if you manufacture furniture and you decreases the inventory of your materials, okay, because in order to manufacture something, you need to use materials, that's an expense, because you're depleting the inventory of materials, and that's an expense, because materials are assets, right? So if you decrease them, expense. Other examples, you have a computer, and you're using this computer for in your business. By using these assets, because computers are assets, you decrease its value, because essentially the value of everything decreases because of its utilization. Computers, cars, equipment, furniture, buildings, anything that has a finite life. It's not infinite. I mean, you're not going to use a computer forever, or a smartphone, or a building even. Therefore, anytime you use something, you contribute to its depletion. And therefore, we're going to calculate this depletion. We're going to calculate this loss in the value. There's going to be an expense. Okay, so several examples we're going to clarify much more better later. The idea is we don't stop at cash. Okay, the revenues and expenses are something more than cash. They include cash, they include changes in cash, but any asset or any liability, we see also how liabilities will work. Any assets or any liabilities can generate expenses and revenues. Okay, and that's the most important message we get, because, as I said on Friday, very often we tend to think of performances in terms of money, right? In our personal economy, okay, we think in terms of cash, we think in terms of inflows and outflows of cash. Cash is important. As a matter of fact, we have the cash flow statement, okay, but that's separated from the income statement. Those are two different statements, because the information that we report is different, not the same information. Otherwise, we would not need two different statements, right, for the same information. So the income statement reports revenues and expenses, which are defined this way. And also, there are many other assumptions about revenues and expenses we need to understand, because once you decide that revenues and expenses are not just changes in cash, and then you need to be more, let's say, more precise in explaining exactly, okay, when do we recognize those revenues and expenses? What is the right moment for recognizing them? If you're not looking at cash, what are we looking at when deciding whether to recognize the revenue or the expense? So we need guidance on the recognition of revenues and expenses. Okay, so as I said, these couple of classes, Friday's class, today's class, those are the most important of the year. So this is essentially the foundations, okay, of accounting. So later on, we're going to use the concept we introduced on Friday and what we are introducing now for the rest of the semester. Okay, so that's why I say the most important classes are at the beginning of this course. If you don't know this, essentially that's going to be a big problem for you at the exam. So, how can we examine the situation knowing that revenues and expenses are not cash, so they can be generated at different stages of the production process? Okay, so you have revenue expenses at different stages. Now, let's assume we have three different stages: the purchase of the inputs, the conversion of the inputs into outputs, and the sale of the outputs. Remember what we said, that businesses and general organizations convert inputs into outputs. Okay, so that's easier to think about manufacturing. a car manufacturer will purchase the materials, steel and the other components, and will convert the materials into a car, and then it will sell the car. Okay, so this is the idea. So we can simplify this complex organization with three different stages of production. Acquiring the inputs, converting the inputs into outputs, and selling the outputs, right? So for each stage, we have revenues and expenses in all three different stages. And then we'll have to decide also whether to keep track of them, recognizing them. We can actually recognize revenues and expenses for all these stages. The first stage, purchase of the inputs. Okay, so we have the, sorry, let me go back, come on. Okay, just a moment. There we go. Okay, purchase of the inputs. Okay, now many of you will agree on me that you have a purchase expense. If you buy some materials for your business, okay, you're going to spend money, right? Typically. Therefore, you have an expense, a purchase expense. By the way, you don't actually need to spend money, because we also said that the transactions, the business-to-business transactions are very often transactions on credit. It means you buy today and pay next month or 2 months from today. So what happens is that you might have a decrease in cash or an increase in liabilities, which is an account payable to your supplier. It's the same. You still have an expense, right? So you don't need a decrease in cash to have an expense. An increase in liabilities is good enough to recognize an expense. So I think we agreed in the case that when you buy something, you have an expense, right? However, we also have a revenue. Now, why is that? Why do we have a revenue?
Because you get some product from it.
Exactly, because you get, we say the material, okay, because you cannot buy products, you can manufacture products. Okay, so in accounting, we reserve the term products to something that we have manufactured, so you cannot buy a product. You can buy a material. Now, material means anything you buy. It could be simple, the raw materials. It could be complex. It could be semiconductors. Okay, it is simply something you purchase from the outside. Something you purchase from another business and you use in your own production. Okay, so anything we buy in order to convert this material into a product, okay, anything we buy in order to convert this item into a product, we call it material. So we have a revenue because we have an increase in assets, and materials are assets. So when you purchase something, when you purchase materials, you have a positive change in your assets and a negative change in your assets, right? So you have less money and more, I don't know, semiconductors, more wood, more materials in general. Okay, so this is the idea, right? So we have both an increase in assets and a decrease in assets. What is the value of those two movements? I mean, the decrease and the increase, are they the same value, or can they be reported at different amounts? There is a reason why it's the same value. Remember, historical cost convention. It means the first time an item, an asset appears in your financial statements, it must be measured at cost. So if you pay 100 for this material, it must be worth 100. Okay. So you cannot just say, okay, I paid 100, but the material is worth 200. Okay, it's not possible, right? Or even you cannot say it's worth less than 100, at least not at recognition. Later, And when you prepare the financial statements at the end of the period, you can measure the materials and say, well, they have lost value because now they are all outdated, out of fashion. Okay, so I don't need them anymore. So I can lower, I can decrease the value of these materials. But when you buy them, the price you pay, imagine you buy materials today, and you agree on the price. The price you pay today, it's the cost of the materials, which is the value you report in your accounts. Now, since the value of the expense, or to be more precise, decrease in assets that determines the expense, it's equal to the increase in assets that determine the revenue, we might as well not report a revenue and an expense by the same amount, right? Because the effect on the net income will be zero. If you have one expense and one revenue which are exactly by the same amount, why are you reporting both? We can choose, for instance, not to report them because their value will be just neutralized in the income statement. So instead of reporting the expense and the revenue, you just report the increase and decrease in the assets. I think that's the possibility. And we see we're going actually to apply this convention, this simplification, because it's easier, but that depends on the accounting system you use. Okay, if you apply the Italian accounting system, you recognize both. Okay, so keep in mind that it depends on the accounting system we use. Since we're using the international, or to be more precise, the American accounting system, we don't recognize the revenue and expenses. We just recognize the assets change. Okay. And there are the other accounting systems out there with different ideas on how to proceed. The outcome will be the same eventually. Okay, it's not like we have different performance depending on the accounting system. The technicalities are different. Okay, so in this case, keep in mind that it's not like there are no revenues or no expenses. We just don't show them because we think it's not very useful showing two items with a different sign and the same amount. They just cancel each other out in your income statement. They neutralize in the income statement. So we might as well not report them. Okay, next step. Is this clear? Do you understand the kind of reason we are making here? Okay, so try to imagine the changes in the assets and liabilities and then apply the definition strictly. Okay, so it's important because you need to realize that we don't really focus on money. Okay, money is one of the assets. Okay, but any other asset can generate revenues and expenses. So if you understand this, we can move on to the second stage when you convert the inputs into outputs. Right? So you're going to use the materials in order to manufacture something new. You're going to use, I'm looking at this desk now, so I see the wood, I see the iron here, there's some glue and some paint. Okay, all of these are going to be put together, plus labor, of course, because you need someone to do this, plus equipment, right? And you put all of this put together and you get something new, something that did not exist before, okay, which is your product. Okay, this is how we use the term, from materials to products. Now, why do we have inputs and outputs here, or why do we have revenues and expenses? First of all, I mentioned a series of inputs, materials, labor, equipment, the manufacturing plant. Those are inputs. Using the inputs is going to cost you, right? So this is the idea, because you need to use the materials. You can only use materials once. Okay, so once you use the materials for one production, they're gone. So you decrease your materials when you use them, right? So if you're using materials, you're going to decrease the inventory, and that's an expense. You're going to pay someone to do this job, and that's an expense. You're going to use equipment, and by using the equipment, it loses value. That's the key. Okay, so by using the machinery, equipment, and so on, those items, those assets lose value, and that's an expense. So you have a series of expenses in order to manufacture something. And then in exchange, you have product, our desk here. Okay, so we have expenses for using the inputs and the revenue because you get something new, something that you did not have before, which is an asset, right? Because when you manufacture stuff like this, it's going to appear in your financial statements, your balance sheet as an asset, an inventory of products. Try to visualize a warehouse, okay, full of these desks, okay, and that's an asset, okay. The warehouse full of desks is the inventories of products. Okay, so this is the asset that increases. So we have both expenses and revenues. What is the value of the items that you have manufactured? Is it greater than the value of the inputs? We say we want it to be greater, okay, but there is a problem here. It's not a simple question, actually. It seems simple, okay. First of all, measuring the value of your product is not simple. I mean, it is simple if you only manufacture one desk, you only this model. All you do is you manufacture thousands, okay, of desks, all the same, all equal. Companies don't do that. Companies typically have a variety of products. They manufacture desks and chairs and maybe shelves and many other products. And that becomes a problem when you have inputs which are common to this production. Maybe the same workers are working on products, or maybe you have some machines that you use for all productions. Okay, this you have a problem of measuring the value of one product. Okay, and this is something that we will deal with when studying managerial accounting. Okay, it is not simple knowing what the value of your product is, because you need to find a way to determine this, because you want to know how much one item costs, because you want to sell it and you want to set the price that generates a profit, right? You don't want to sell something below its cost. But let's assume we know how to measure the cost. Okay, so let's remove this problem for the moment. So we know exactly how much this desk cost us. Okay, so what is the value of the output we have obtained? It should be greater, right? Otherwise, why engaging in this manufacturing process? But the problem is, can we really recognize this greater value at this stage? We're just converting the inputs into the outputs. We haven't sold it yet. Okay, that's the key. We haven't sold the output yet. Nobody, I mean, in theory, nobody prevents us from saying, well, this desk cost me 100, it is worth 120. Okay, nobody prevents me from doing that. So from saying that the revenue is greater than the expense. Okay. However, this creates a problem, because when you do that, what happens to your income statement? Because remember, revenues and expenses are reported in your income statement. So when you recognize a value to your output which is greater than the value of the inputs, what are you showing in your income statement?
Increase.
An increase in, how do we call this increase?
Profit.
A profit. You're showing a profit, right? Remember, with revenues minus expenses. The revenues are greater than expenses, profits, right? In your opinion, is it correct to report a profit at this stage? Not yet. We haven't sold yet. So even if you're confident that you're going to sell, remember that we need to be conservative. Remember, this is the reason why we don't report a profit. Even if you're confident that you're going to sell this desk at 120, as long as you haven't sold it, you just don't report this profit because that would be an unrealized profit, right? There's no customer yet. Okay, no one has agreed to pay 120 to you. So it's too early to report a profit. And this is our, let's say, choice, because in theory, you could recognize a profit, right? Because if you look at this, you have a revenue and you have an expense. So we are choosing not to report it on purpose, because we don't want to report profits from converting the inputs into the outputs, because we want to be conservative. We want to apply prudence in accounting. Okay, this is one of the consequences of prudence. You don't report profits before selling your product. Okay. And which is, as you can see, it's a choice we have made, because you could as well recognize a greater value and then you have a profit, but that would not be consistent with the prudence principle. So once again, we choose to report the value of the output at the equal to the value of the inputs. Okay, so if you use inputs worth 100 for your desk, then the desk must be worth 100. So what happens in your financial statement? You have less assets, such as materials. You have less money. You have less equipment. You have less plant machines and so on, and you have more products. Once again, the cost of using the input will be equal to the revenue from the inputs. So, once again, we could say, well, maybe we could just not report the revenue and the expense, right? Why? Because we might say, well, since their value is the same, we just report increase in the asset and decrease in the asset. Okay, that would be also an option. We see that this is very close to what we're going to do, although you still have the option to report both items, both the revenue and the expense. It depends on the accounting system. The Italian accounting system reports both. Okay. The international accounting systems that we use does not report the revenue and the expense. We'll see how it works when we'll discuss about bookkeeping. And this is actually something we see towards the end, because it's about manufacturing, which is the most complex part. So finally, we get the third stage, selling. And that's finally the moment when we can recognize the profit at last. Okay, because finally you have a sales revenue, because now you sell this on the market, and we say, for instance, it could be the selling price would be 120, okay, for your desk. And so you get a revenue because the customer pays, so you increase your assets. Even if the customer does not pay, you increase your accounts receivable, so you have the right to be paid, as long as there is a customer. Okay, so as long as someone agreed to pay, then you have a revenue. You don't need the money, okay, but you need the customer. So it's not just your expectation about the future. You have an actual customer that said, yes, I'm going to buy this. Please send me this desk to me and send me the invoice. I will pay you later. Okay, I'll pay you next month. It's still a revenue because of an issue that we need to clarify. Because the revenue recognition first. We do recognize the revenue. So we do have a revenue by 120. However, we also have an expense, which is called cost of sales or cost of goods sold. Because in exchange of this revenue, you need to deliver an asset, which is this one. Okay, so you deliver your desk. And this time, or finally, the values are not the same. Right? Because if you want to make a profit, you want the sales revenue to be greater than the cost of sales. You want to sell this desk at more than 100, which is the production cost, because you want to make a profit. Right? So the desk, which is an asset, in the inventory of an asset, is going to be delivered to the customer, and that decreases your assets by 100. And then you get money from your customer by 120. And this time we report both, because they are different. Okay, we report both items. So in our income statement, we're going to report sales revenue 120 minus cost of sales 100. Okay, and this time you realize, well, there is a profit. And I can recognize this profit now because I have sold. It's not my expectation. It's not my, hope about the future. That's something that happened. So I can do that. Okay. So this is how it works. And you can apply this to any input and output in reality. Okay. But you see that most of the time, since we tend not to report revenues expenses that have the same amount because they just cancel each other out. Very often we just focus on the asset side, okay? On the asset and liability side, and we will just forget the equity side of the equation. Instead, when the sales revenue and the cost of sales are different, we report both because we want to emphasize this difference. And this is the first approach we have to revenues and expenses, and that will make us realize that they appear at any stage. Okay, not just sale, or not just the purchase. Okay, even converting into output generates revenues and expenses, because each of these stages involves changes in your assets and liabilities. Okay, so this is the idea. Changes of the assets and liabilities in your balance sheet, and therefore revenues and expenses, because we are talking about production. So as you can see, shareholders are not involved here. Okay, shareholders have nothing to do with this. So we're talking about production. So any changes we observe in the assets and the liabilities must be part of your production. So this is the idea, and we need to now to better understand what we are doing here, because this method that is measuring revenues and expenses as changes in assets and liabilities is called accrual accounting, okay, as opposed to cash accounting. Okay. In cash accounting, you only look at cash. You measure revenue expenses on the basis of cash. We don't do that. Okay. Instead, we apply something called accrual accounting. Accrual is essentially accrual essentially means accumulation. Okay, so accrual accounting means that we report revenue expenses regardless of the cash movements. Instead, we recognize revenues when they are earned and expenses when incurred. Of course, we need to explain what that means, right? Because we need guidance, as I said. Since we cannot look at cash accounting is much easier. Cash accounting, just look at the cash. And you see cash, revenue. You pay cash, expenses. Okay. This is how we use accounting in our personal finance, okay, because we think in terms of cash, inflows and outflows of cash. It's easier. When you start using accrual accounting, it becomes more complex, because first of all, any asset or liability can generate revenues and expenses, and secondly, you need to find a rule that says, okay, this is when I recognize the revenue, this is when I recognize the expense. Okay, so revenues are recognized when earned. I explain what that means. And expenses are recognized when incurred. So we have rules regarding revenue recognition and expenses recognition. Okay, so we need to apply in order to understand what's going on. So this is what we're going to do, and typically, in order to use accrual accounting, A simple, statement of changes in cash is not enough for us to keep track of all possible transactions. That's why we need double entry bookkeeping, more advanced tool to keep track of all the changes in the assets and liabilities and of all the expenses at the same time. Okay, so this is the idea. Because if you only have the problem of looking at changes in cash, then probably you don't need double entry bookkeeping. Okay? You need a single entry bookkeeping, inflows, outflows of cash. So, as I say, your family budget works like this. Okay, so I spend 100 on rent and 50 on groceries, and I get 500 salary. You might just have one single column, okay, of inflows and outflows as your account. It does work for firms, because if you use accrual accounting, you need more information. You need to specify that cash has changed, and then you need to specify what the reason is. Is it an expense? Is this a revenue? Is this a dividend? Is this a contribution? So we need double entries. We'll learn when we continue with this topic. So this is the idea, and after the break, we're going to explain the reason why we use accrual accounting, which is more complex. Okay, it would be easier. Okay, our lives would be easier if we use cash accounting, as you can imagine. But we do use accrual accounting. Why is that? Well, I explain why, but also when I talk about the history of accounting, I will introduce some reasons. For instance, the Industrial Revolution generated the need for assessing the performance of long-term investments. Think about railroads. Okay, so it takes 10 years to make a profit. So if you just measure cash, it doesn't work, because you have 9 years of losses, and then on the 10th year you have the profit. And nobody will invest in stuff like that. Okay, so we'll explain how it works and why we need it after the break. So we'll continue in 10 minutes. All right. So we just introduced this distinction between, what is this? With a question, yes.
What the accrual accounting is.
Excuse me?
Accrual accounting is.
Accrual accounting is, sorry, I can't hear you.
What is accrual accounting?
Yes, it's just, we just talked about this. It's the accounting we use is called accrual accounting as opposed to cash accounting. So maybe it's easier to say, well, it isn't cash accounting. Okay, so what we explained in this slide here, okay, the part that we recognize as revenue expenses in each stage, that's accrual accounting. Okay, because if you use cash accounting, you only recognize revenue expenses when you pay money or when you collect money. Instead, we don't look at money, we look at assets and liabilities. That's accrual accounting. Okay, so accrual accounting is when you define revenues and expenses as changes in the assets and liabilities. That's accrual accounting. Because otherwise, I would have said, well, revenues and expenses are changes in your cash, in this cash accounting. I did not say that. I use assets and liabilities to explain what revenues and expenses are.
So we use accrual accounting with two columns, in the first two columns, right?
Excuse me, we use
accrual accounting in the first two columns.
We use accrual accounting in all the company. We don't use cash accounting sometimes, and we only use accrual accounting. Okay, so when we continue, we become clear what it is because accrual accounting reports both cash and non-cash transactions because cash is an asset. Okay, so we said any change in assets can explain revenues and expenses. So we report both cash transactions, but also, which is the only thing that cash accounting reports. We also report non-cash transactions. It is the key here. So, what are non-cash transactions? Well, for instance, you might purchase some inventory of materials on account. It means you don't pay right now. Okay, so you don't have a payment, but you do have a liability. You have an account payable, and that's enough in accrual accounting to recognize the expense. So you recognize the expense, so you record the transaction, even if you don't have any money involved. Not yet, at least. Also, rather important, this is very, and we'll spend some time on this, we also recognize sales on account. That is, if you sell and you don't collect the money right now, okay, but you're going to collect this money sometime in the future because you have an agreement with the customer, you do recognize the sales revenue today, not when you collect the money. That's accrual accounting because you still have an asset that has increased, which is the right to collect money. That's an asset. We call it the account receivable. Okay, so when your account receivables or accounts receivable increase, okay, you have a revenue. Even if you haven't collected the money yet. Okay, so once again, we don't look at the inflows of cash in order to recognize the revenue. Now, of course, you might wonder, well, what if the customers don't pay? Okay, that's a risk. Okay, we run, and we see how to deal with that risk. That's also the reason why we need a cash flow statement, because we want to know whether the firm sells, but also we want to know whether the firm collects its money. Okay, this is important because, very often the main problem with firms not selling is getting paid. That's the real problem. Okay, so many companies are good to sell, the small firms. Okay, they're very good at selling, not that good at getting paid. So collecting the money is essential because without collecting the money, you cannot survive for long. So we need, of course, to look at cash. We need to keep cash under control. However, this is not how we define revenues and expenses and performances. Okay, so we do recognize sales on account. We do recognize depreciation expenses. The name suggests that a decrease in the value of something, right? So we recognize decreases in the value of our assets as expenses. The assets are still there, they haven't gone anywhere, but they have lost value for a variety of reasons. But in this case, when we talk about depreciation, when we use this term, depreciation, we mean the assets have lost value because of utilization, because we use them. Okay, so since we are using the assets, they lose value. That's called depreciation. It's an expense, because if you measure this decrease in the value, then you have a decrease in the value of your assets, and therefore you have an expense. Okay, so we'll explain how it works. It's one of the main expenses in companies. Okay, so one of the most important expenses, depreciation, because if you have investments in property, plant, equipment, then you have depreciation. So this is the idea. Other, let's say, technical terms, accrual of expenses. Okay, what is that? Well, it means that you have recognized an expense you haven't paid yet. For instance, you know that we are going to get the telephone bill for the month of October. And typically you get this in November or December. Well, if you want to calculate your expenses for October, the cost of this telephone bill would be accrued, would be recognized already in October, even if you haven't paid yet, because you are going to recognize the liability instead of a cash payment. Okay, so it is very important to recognize the expenses at the right moment. So if you're using a resource in a specific moment, in a specific period of time, the expense should be reported in that period, not in some other period. So if you're using telephone services in October, then the expense should appear in your October financial statements. Okay, if you prepare monthly financial statements, which some companies do actually internally for internal purposes. Some large companies prepare monthly financial statements. Okay. So it does not matter when you pay. You should pay in December or whatever. The cost of the resources must be reported in the same period when you use the resources. And this is one of the main problems for us, okay, because this is not always simple and easy to do. Sometimes it requires a bit of effort on our side to report the expenses at the right moment. Usage of prepayments. Maybe I already used this term. I said sometimes you might pay in advance for some services, your rent. I think some of you experienced it already. Okay, so you pay 3 months, 6 months in advance. Or insurance. If you buy insurance for your your scooter or anything, you're going to pay for 1 year in advance. Okay, so you pay today and you buy insurance for 12 months. This is called a prepayment. Okay, so once again, since we don't use cash accounting, this prepayment cannot be considered an expense because you haven't used the resource. Okay, that's the idea. So only when you use the resource can you report the expense in your income statement, not before using. So payments are not really relevant. You might pay before using this resource, after using the resource. It doesn't matter. The expense should be recognized only in a moment when you actually use the resource. Now, when you use rent, well, when you use the apartment you're renting, you're using your rent service, right? When when do you use insurance? Well, insurance, it means that it is, you have transferred some of your risks to someone else. That's what insurance is. Okay, so you buy insurance because you want to transfer a risk to someone else, the insurance company. So if you have a scooter, you have the risk of causing damages to someone else. Okay, so, and therefore you want to transfer, you have to because it's mandatory, but you want to transfer this risk to a third party, so that if you cause damages to someone, the insurance company pays for you. Okay, this is the service you're buying. Well, since you buy insurance for a period of time, the same way you buy rent, okay, for a period of time, you're covering with this insurance policy a period of time, and therefore you're going to use this resource as time passes. Okay, this is the idea. So each day you're using a small portion of this service. The same day you could calculate the daily rent for your apartment if you wanted to. Okay, so every day you're going to use a very small portion of this service. And we need to recognize the expenses of those services as we use them. Now, of course, nobody prepares daily financial statements, but for instance, it might happen that you have both insurance in October, and then in December you need to prepare the financial statements. Okay, so you're going to report 3 months of insurance in the income statement, October, November, December, but not the remaining 9 months, which are going to be reported in 2022, right? So, and this is regardless of the payment. Okay, so we'll see how it works. As I say, double-entry bookkeeping is a powerful tool that will allow us to put this in practice. Okay? Because in theory, it might sound a little bit difficult to understand and also very theoretical, but then you apply this in practice, you realize, okay, this is how I do it. And using double-entry bookkeeping will really make you understand the inner working, okay, of this method. Supplies. Remember the restaurant, okay, we buy supplies. Buying supplies by itself, well, by itself does not really generate the expense of using them, okay? So we wonder about using the supplies, not buying them. In fact, we say when you buy something, you have an expense and also revenue, and they have the same amount, okay? And then you start using the supplies. So you might buy supplies today and use them in November, and the expense of using the supplies will appear in November, not in October. Okay, so this is the reason why we can't recognize those kind of expenses, because we don't just stick to cash. We don't just look at money. We look at the assets. Supplies are assets. Prepayments are assets. Property, plant, equipment, those are assets. Okay, so we look at assets and liabilities. We don't just look at money or cash. So now that would lead us to something which is essential. Okay, essential for us to understand how, which is when to recognize revenue. Because we say we don't look at the money, okay, in order to recognize revenue. So when do we recognize revenue? Let me explain this with an example. Let's say that you have a firm and you receive a phone call from a customer, okay, and this customer places an order, or maybe through their website, okay, through your website if you're selling online. Anyway, when you receive the order, it means that the customer says, I want this, and I agree on the price that you're asking. Okay, this is the order. Then what happens? Then you deliver the item to the customer, and this is the second stage. And third stage, the customer pays. Okay, those are three different stages. Now, if you think about a grocery store, those three different stages will happen at the same moment. Okay, you choose something from the shelf, you bring it to the cash register, and you pay. Okay, so this essentially order, delivery, and payment, they will happen at the same moment because that's retail. Okay, in retail, selling to final customers such as us. Okay, typically, very often those three moments will happen at the same time. In business-to-business transactions, this is typically separated. The three stages will happen, let's say, in three different moments. Okay, so today I place the order. 2 weeks from today, even more because factories have something they call the lead time, how long it takes to produce something. Okay, so if they don't have it ready in their warehouse, they need to produce it. Okay, it can take 5 weeks, 8 weeks, 1 year. Okay, currently, if you order semiconductors for your production, it takes 1.5 years to get them because there is shortage of semiconductors, there is shortage of materials they're in overproduction, so factories cannot keep up with the demand. Okay, so if you order today, you get it 1 year from today. So really, that's disrupting production of washing machines, cars, and everything. Everything that has electronics inside is going to be production to be disrupted. Anyway, you place the order today, you get the delivery of the item somewhere later, let's say 2 weeks later, and then you have 60 days to pay. Okay, this is how it works in business-to-business transactions. So, from the point of view of the seller, okay, when does the seller recognize the revenue? When the seller receives the order from the client, when the seller delivers the product to the customer, or after 60 days, when the customer pays. We have three different, at least three different options of recognizing the revenue. So what do you think is the most appropriate choice, given what we have said about accrual accounting? So we don't do cash accounting. We look at the changes, the assets, and so on. Excuse me?
When you realize the transaction.
Realize means when you collect the money.
No.
What do you mean by realize? It's correct. I would like you to explain what realize means.
Before you collect the money.
Okay, so before you collect the money, why is it, this is a very good point, why is the transaction realized even if you haven't collected the money? Because normally, when you talk about the realization, we think of money, right? In reality, a transaction is realized even if you haven't collected the money, it's realized as long as you have the right to collect the money. It means it's realized. Okay, so you have a buyer. Okay, this is a very good point. So, is the transaction realized when you receive the order from your customer? Not yet. Why not? It's too early to recognize the revenue. Can you see why? Yes?
Because you can return it back.
For instance, first of all, you could return the item, or you can even cancel the order before shipment. Okay, or you might not be able to fulfill this order. Maybe you receive the order, you say, yes, okay, then you realize, well, I don't have this. I thought I could provide this product within the time that the customer requires. And if the customer does not want to wait, you can say, well, I'm sorry, but I don't have it. Okay, so the orders can be canceled. Okay, so it's a bit too early recognizing a revenue when you just when you just receive the order. On the other hand, when you deliver the good, it means you have the item that the customer wants to buy. You deliver this item to the customer. Okay, so as far as you are concerned, your obligations have been fulfilled, right? So you have done what the customer is asking you to do. And even if you haven't collected the money yet, Okay, that's the moment when you should recognize the revenue. You don't wait stage 3, okay, it is the collection of pay of the money, because it's too late. Because once again, we don't look at money when recognizing whether to recognize revenues or not. Revenues are recognized when you deliver the items. So let's try to explain this a little bit better, because this is called the revenue recognition principle. Okay. Now, in general, in order to be recognized, we're talking about sales, for instance. Okay, a revenue from sales should be recognized when it is realized, and we have discussed what it. We said, okay, it must be a customer, but also when it is earned. That's something we haven't mentioned yet. What does it mean? Well, realized means that the product or service, because we can also sell services, that we have the same problem. The product or service has been exchanged for cash, okay, that would be cash accounting, or simply claims to cash. Okay, this is very important. So not just cash. Clearly, if you have a grocery store and you pay cash, okay, in order to, okay, what's going on here, and you pay, okay, it doesn't work, and you pay cash to when you buy, that's of course realized revenue. Okay, but even claims to cash are accounts receivable, the right to collect money. And that's the first condition, realized. And then the revenue must be earned. That is, the seller must do what the customer is asking. Okay. Which in case of a purchase of goods, the seller must deliver the goods. And that's the obligation of the seller. Okay. And in case of services, the seller must perform the service. Okay, so if they hire you to do some consultancy, if someone asks you to perform some consultancy for a client, then you earn your revenue when you perform this task, when you render this service, okay, not when you receive the job. Okay, when the customer agrees to pay, but when you actually complete the job. So typically, both criteria are usually satisfied when you deliver the goods or when you perform the service. Okay, you meet both criteria typically. So when you deliver the goods, then it means that you have done what the customer is asking, and the revenue is realized because there is a customer that agreed to pay. Now, you cannot recognize the revenue when you receive the order because it is not earned yet. Okay, it is not earned, therefore the seller has not completed all the activities which are needed in order to be entitled to the benefit. Okay, this is the formal definition. But it means the seller has not done what the customer is expecting from the seller. If I buy something, I expect to receive what I buy. Okay, so as long as the seller does not comply, this revenue is not real. It's not earned for the seller, so they cannot recognize it. So sellers recognize the revenue when they ship the items, when they send the items to the customer. It is when they recognize the revenue. Because at that moment, the revenue is both realized and earned. This creates special problems sometimes because if any of you have had any experience, or maybe in your family, of, for instance, buying a car, okay, typically you pay in advance a portion of the price, okay, so, or a house, okay, so sometimes you pay a portion of the price in advance, and then you pay the remaining part, the balance, when the car is being delivered. Okay. Now, this advance payment the seller collects from you is not a revenue because they haven't done anything yet. Okay, so they haven't completed their activities And so they cannot recognize this money they collect as revenue. How do you recognize an advance payment from your customer? So your customer pays in advance, and because just a portion, okay, advance payment of the total price. And then, of course, the agreement is a few weeks from today, I'm going to deliver the goods and you pay me the rest, the balance. If not a revenue, what is it then? This money that you collect is not a revenue. But however, the basic accounting equation must balance assets minus liabilities equal to equity, right? So what is it then? An asset. Okay, cash is an asset. You cannot just increase cash and that's it, because otherwise the equation will not hold true, right? If you increase the assets by the amount of money you get, and then you don't do anything else, your equation will not balance. The equation must balance. Assets minus liabilities are equal to the equity. You cannot increase the equity because it's not a revenue, which is how it would balance normally. Right? When you collect money, you increase the equity and the assets. But you cannot do that because you don't have a revenue. So what do you do then? You increase the liabilities. You have an obligation. That's therefore, you increase your money, you also increase your liabilities because you have an obligation towards the customer. This is how it works. We're going to use, and later on, we are going to talk about tomorrow, we're going to use the basic accounting equation to analyze each single transaction this way. Okay, so what happens with assets? What happens with liabilities? What happens with the equity? This is how we understand the effects of transactions on the financials of the firm, on the assets, liabilities, the equity, revenues, expenses. Okay. We will always keep for every transaction the basic accounting equation in mind. So, if you collect an advance payment from your customer, the revenue is realized, of course, because I mean it cannot get more realized than that. It's money, okay? So it cannot get more realized than that money, but it's not earned because you haven't done anything yet. Okay, so both criteria must be recognized. Okay, must be met in order to recognize the revenue. And if you offer services, the same. If you ask your client for an advance payment on a service you still haven't performed, you haven't realized revenue, which is not earned. So no revenue, once again. Okay, so we learned that this is called an unearned revenue. A revenue you haven't earned yet. Okay, which is not a revenue clear with. It must be something different, and to be more precise, it is a liability. When you recognize expenses then, if this is when you recognize the revenues, what about the expenses? Now, we do have guidance about revenues that says this is when you recognize the revenues, and then we attempt. It's an attempt, it's not 100% precise. We attempt to match the expenses to the revenues. That is, we try to say, okay, now I have recognized this revenue. Let's report in the same moment, the same period, not moment, period, okay, the same income statement, all the expenses that contributed to this revenue, that helped me generating this revenue. Okay, so this is the matching principle. We match expenses to the revenues. So we'll see how this works in practice. Once again, in theory, it seems a little bit of bug, okay, but we'll see that when we'll learn how it works in practice, we realize that it's really straightforward. So if you recognize the sales revenue when you deliver the goods, you should also recognize the cost of sales at the same moment, right? So you try to match the expense of your goods to the revenue. So, and this is something not probably obvious. So you don't report an expense until you have the revenue. So let's assume you manufacture furniture, okay, our usual example. And in order to manufacture furniture, you need to pay someone to do it. You need to use materials. You're going to use electricity. You're going to depreciate your property, plant, equipment. You have a series of production costs. They translate into a product, okay, whose value is equal to the production cost, we say, right? Well, until you sell this product, you don't report any expense because you have nothing to match these expenses with. When you have the sales revenue, then you match the expenses. Okay, I also have a cost of sales. Is this?
What if there's no revenue?
No expenses. So if there's no revenue, you don't have expenses, is the key. Okay, so where is your production if there's no revenue? If you produce without selling, where is your production? Where is it physically?
Sorry?
Where physically, if you manufacture furniture without selling it,
Loss.
well, we'll see that. We'll see whether there's a loss or not. There is a loss, but there is a reason why there is a loss. And it is not equal to the production cost, as we'll see later. But anyway, let me go back one step. If you manufacture furniture that you haven't sold, where is it?
Asset.
It's an asset, okay? It's in your warehouse. It's an asset, right? So you can manufacture millions of desks, and you don't sell them. You have those desks among your assets. Okay, so it means that you have converted some resources into a new asset, okay, which is your inventory of products or inventory of finished goods. So as long as you don't sell this asset, you cannot report a cost of sales, right? So if you don't sell it, you don't have a cost of sales. You don't have revenues, but you don't have cost of sales either. When you start selling the asset, then you have cost of sales. And then you can compare the sales revenue with the cost of sales and determine whether there is a profit or not. That's why measuring the value of your production is important. That's why plenty of problems in manufacturing arise from the measurement of the production. Okay, how much is production worth? Should we include advertising in the value of this furniture or not? This is a choice that we'll have to face, and we'll see how it works. So, in reality, we attempt to match the expenses to the revenues. We don't report the expenses if we don't have any revenue to which we can match them. Okay? This is the basic approach. Now, let me show you this by looking at the income statement, okay, so that we have, we'll forget about this part for a moment, so that it is more understandable what I'm trying to say. And let me go back to the Qatari's financial statements. We saw their balance sheet the other day, remember? And now we're going to have a look at their income statement. Okay, let me just. Okay, I need to get rid of this stuff here. No, it doesn't work. Okay, so I need to use my mouse. You know what? Let me just change the view here. All right. All right. So it's easier for me this way. So this is the profit or loss account, or income statement, or statement of performance. Okay, so different names for the same statement. Let me zoom out so we can read the numbers. Not enough. Almost there. All right. So Campari is preparing the income statement for the year 2020. Okay, how you can read the numbers in the back. And they start with sales. Okay, so sales is the first item you see in any financial statement, any income statement. The first item is sales. So sales are equal to, you see here, 2.2 billions. Okay, those were the sales in 2020. If you compare this with the 2019 sales, you see that this is rather similar, which is remarkable, given what happened in 2020, and given that, bars and restaurants were closed. Okay, so certainly it's a remarkable achievement. So they have sales. Then there is something that unfortunately I have to explain right now because it's here, excise duties. Okay, because since they are dealing with selling alcohol, essentially, okay, so spirits and wines, there are taxes to pay, and maybe if you smoke, okay, or if you ever have bought a bottle of spirit in your life, maybe you have, there is a smart of label that you need to break in order to open the bottle or to open the pack of cigarettes. Okay, with the label, essentially that's the proof that the tax was paid. For each single product, manufacturers of some items, tobacco products and spirits must pay a tax to the state for each single product. Okay, it's called an excise tax. Because in theory, only the state can produce tobacco products and spirits. Okay, so the state gives this privilege to a private entity, and this private entity pays a tax for each single item they produce. Okay, this is called an excise duty. It's a really ancient tax, as you can understand, and it dates back from centuries ago. Okay, we still have it. So for a company that produces products such as spirits, which are subject to this excise duty, they have to pay this tax for each single bottle, okay, of spirit. So their net sales would be the sales minus this tax. It is why they report here the net sales. And then once you get here, net sales, you have the cost of sales. Okay, so what is, and by the way, see the brackets? The brackets are negative numbers. Don't tell that to Professor Bozzi, but in accounting, numbers between brackets are negative. Why? Because as we learn, starting from tomorrow, not from tomorrow, from Wednesday, in accounting there are no plus and minus signs. There are debit and credit signs, which are accounting signs. Okay, so we have our own way of calculating minus and pluses. Okay, so minus 746, that's the cost of sales. What is the cost of sales? The cost of one bottle of spirit for the company, the production cost. Okay, so you can see what the margins are. Okay, and excuse me, the gross profit, it's not a net profit because there are other items to consider. So we have this distinction in accounting between net and gross. Okay, the gross profit is 1 billion. Okay, so more or less it means that their gross profit, okay, is the difference between the net sales and the cost of the bottles, of the items they sell, of the spirits they sell. Okay, that's the gross profit for them. And then in order to sell this, besides production, it's in a strict sense, besides manufacturing, you also have to advertise the product. You're going to have general expenses, you're going to finance the corporation, and other expenses we're going to find below here in this statement. But let's focus on the first part. You have the sales revenue and the cost of sales, okay, which is what we said was the last stage of the production process. All right. Now, most of our problems will arise from cost of sales in manufacturing, which is complex. That's why we'll leave this for later. And we'll begin with merchandising, which is easier. Okay, so companies buying and selling goods.
Campari is not a merchandiser, it's a manufacturer because they manufacture what they sell. Therefore, measuring the value of what they manufacture, it's a problem. It's quite a complex problem in reality. But we'll discuss about this later. So on Wednesday, we continue with explaining this idea of revenues, expenses, and then we start introducing double-edged bookkeeping. Okay, finally. So we start introducing the technique we use in order to keep track of all those changes in the assets and the liabilities. Okay, so I'll see you on Wednesday, and we'll meet in the afternoon as always at 3. Goodbye.